Have you ever wondered why 90% of traders end up losing money in the markets? It's not because they lack intelligence or information. In fact, many unsuccessful traders are incredibly smart people with access to the same tools and data as the profitable ones. The real difference lies in something much deeper: the psychological foundation that either supports or sabotages your trading decisions. Today, we're going to explore the hidden psychological traps that destroy most trading accounts, and more importantly, the evidence-based strategies you can implement to overcome them. This isn't about some mystical trading secret or a get-rich-quick strategy. It's about understanding the fundamental reason why smart people make irrational decisions when money is on the line. Let's start with a simple truth that most trading educators won't tell you. The market doesn't care about your feelings. It doesn't care if you need to make your mortgage payment this month or if you're trying to escape your 9-to-5 job. The market is simply a reflection of millions of decisions happening simultaneously, and it will happily take your money if you approach it with the wrong mindset. So what exactly is happening in your brain when you trade? When you enter a position, your brain's reward system activates. Dopamine releases as you anticipate a potential gain. This feels good, similar to what happens when you get a like on social media or win at a casino. But this dopamine hit can quickly become problematic. When you're in a winning trade, your brain wants more of that good feeling. This is where greed starts to take over. Maybe I should add to my position. What if I hold a little longer for more profit? These thoughts aren't rational analysis. They're your brain chasing another dopamine hit. And suddenly, your winning trade reverses and turns into a loss. On the flip side, when a trade goes against you, your brain shifts into protection mode. The amygdala, your brain's fear center, takes control. Your thinking becomes clouded. Rational analysis disappears. All you can focus on is stopping the pain. So you might exit too early at a small loss, only to watch the market reverse and hit your original target. Or worse, you might freeze and do nothing, watching your small loss grow into an account-destroying disaster. This cycle of fear and greed isn't just some trading cliche. It's neurologically hardwired into your decision-making process. And it's exactly why most traders fail. They're not trading with a system. They're trading with their emotions. Let's take a deeper look at how this plays out in real trading scenarios. Have you ever found yourself hesitating to take a trade even though it met all your criteria? That's fear of loss at work. Or have you ever moved your stop loss further away to give the trade more room? That's your brain trying to avoid the pain of admitting you were wrong. These psychological biases don't just affect new traders. They can plague experienced professionals too. The difference is that successful traders have developed systems to recognize and overcome these biases. This brings us to one of the most powerful concepts in behavioral finance: systematic trading. A trading system isn't just about entry and exit rules. It's about removing emotional decision-making from the equation. When you have a well-defined system, you're no longer asking, "How do I feel about this trade?" Instead, you're asking, "Does this situation meet my predefined criteria?" The beauty of systematic trading is that it acknowledges a fundamental truth. Your emotions will always try to hijack your decision-making. Rather than fighting this reality, you work with it by creating rules and boundaries ahead of time, when you're thinking clearly and objectively. Let me give you a concrete example. Imagine you're trading a breakout strategy. Without a system, you might see a stock breaking through resistance and jump in because it feels like it's going to run higher. But with a systematic approach, you have specific criteria. Volume must be 200% above average. The stock must be in the top 25% of its sector performance, and you must have a clearly defined risk level at the most recent support. This systematic approach accomplishes two critical things. First, it ensures consistency. You're taking the same types of trades over and over, which allows you to collect meaningful data about what works and what doesn't. Second, it creates an emotional buffer. When a trade doesn't work out, it's not a personal failure. It's just part of the statistical expectation of your system. This brings us to another crucial aspect of trading psychology: risk management. Many traders focus exclusively on finding winning setups, but professional traders know that risk management is actually more important than entry signals. Think about it this way: if you're risking 5% of your account on each trade, you only need to lose 20 trades in a row to completely wipe out your account. But if you're risking 1% per trade, you can withstand over 100 consecutive losses. The reality is that no trading strategy wins 100% of the time, so your ability to control risk will ultimately determine your longevity in the markets. Risk management isn't just about position sizing, though. It's also about understanding your own psychological limits. If seeing a $500 loss causes you to panic and abandon your strategy, then you're trading too large. even if that amount is technically within proper position, sizing guidelines for your account. This personalized approach to risk management addresses one of the most common psychological traps: overtrading. Many traders fall into the mindset that more trades equal more opportunity. But in reality, overtrading often stems from a scarcity mindset, the fear that if you don't catch this move, you might miss out on profits forever. Successful traders understand that the market will always provide new opportunities. They don't feel compelled to be in a trade at all times. Instead, they wait patiently for setups that meet their exact criteria, knowing that high probability opportunities will inevitably present themselves to those who wait. Patience is perhaps the most underrated trading skill. In a world that rewards instant gratification, the ability to wait for the perfect setup is rare. But market success doesn't come from activity, it comes from precision and discipline. This leads us to another critical psychological pattern: the need for certainty. Many traders burn through account after account looking for the perfect system that never loses. But this pursuit is fundamentally misguided. Trading isn't about finding certainty, it's about getting comfortable with probability and uncertainty. Even the best trading systems have losing streaks. What separates professional traders from amateurs is their ability to execute their strategy consistently through those inevitable drawdowns. They understand that a 60% win rate means they'll lose 4 out of every 10 trades, and they're psychologically prepared for that reality. So how do you develop this kind of psychological resilience? It starts with reframing how you define success in trading. Instead of focusing exclusively on profits and losses, successful traders judge themselves on how well they executed their plan. Did you follow your entry criteria exactly? Did you manage the trade according to your predetermined rules? Did you size the position correctly based on your risk parameters? By focusing on the process rather than just the outcome, you build confidence in your approach, regardless of whether any individual trade wins or loses. This process-oriented mindset is what allows professional traders to remain calm and clear-headed even when facing a series of losses. Another powerful psychological technique is the trading journal. By documenting your trades, both the technical details and your emotional state, you can identify patterns in your decision-making. Maybe you consistently overtrade during certain market conditions, or perhaps you have a tendency to cut winners short on Fridays. These patterns aren't obvious in the moment, but they become clear when you review your trading data systematically. The trading journal also serves another important purpose. It creates accountability. It's easy to bend or break your rules in the heat of the moment, but when you know you'll have to document and review those decisions later, you're more likely to stay disciplined. Discipline is ultimately what separates consistently profitable traders from the rest. It's not about having an iron will or never feeling fear. It's about creating systems and habits that allow you to act in your long-term best interest, even when your emotions are pushing you towards short-term relief. This is where having a community of like-minded traders becomes invaluable. When you're surrounded by others who share your commitment to systematic trading and proper risk management, it reinforces positive habits. You're less likely to throw away your strategy after a few losses when you see others in your community weathering similar drawdowns with patience and discipline. A good trading community also provides perspective during difficult periods. Markets go through different phases, and sometimes certain strategies temporarily underperform. Having experienced traders in your corner can help you distinguish between normal strategy variants and legitimate flaws in your approach. Let's talk about another psychological trap that derails many traders: the attachment to being right. Our egos crave validation, and there's a certain satisfaction in saying, "I called it," when a stock moves in the direction you predicted. But this need to be right can be expensive. Professional traders don't care about being right. They care about making money. They're perfectly happy taking a small loss when the market proves their initial thesis wrong. In fact, they view the ability to admit mistakes quickly as a strength, not a weakness. This detachment from ego allows professional traders to stay flexible and adapt to changing market conditions. They don't fall in love with their positions or their predictions. They simply follow what the market is telling them, adjusting their approach when necessary. Another subtle psychological trap is the influence of external opinions. In today's world, we're constantly bombarded with market commentary, from financial news networks to social media finance influencers. Each voice has an opinion about what the market will do next, and these opinions can easily cloud your judgment if you're not careful. Successful traders learn to filter out this noise. They might stay informed about broader market conditions, but they make trading decisions based on their own analysis and systems, not on what some commentator or Twitter guru predicted. This independence of thought is critical because it allows you to take full responsibility for your trading results. When you blame external factors for your losses, the Fed, market manipulation, your broker, whatever. You surrender your power to improve. But when you take ownership of your results, you gain the ability to learn and grow from every experience in the market. Speaking of learning, let's address perhaps the most dangerous psychological trap: the unwillingness to invest in proper education. Many traders will spend thousands on a state-of-the-art trading setup or premium data feeds, but balk at investing in quality trading education or mentorship. This resistance often stems from the mistaken belief that trading should be easy, that anyone with a chart and some indicators should be able to figure it out. But trading is a profession, just like medicine or law or engineering. Would you expect to become a doctor by watching YouTube videos and experimenting on yourself? Of course not. Yet many approach trading with exactly this mindset. The truth is that proper trading education is an investment, not an expense. It can save you years of costly trial and error and help you avoid the psychological pitfalls we've discussed today. So where do you go from here? How do you put these psychological insights into practice? It starts with honest self-assessment. Take some time to review your trading history and identify your particular psychological weaknesses. Do you struggle with cutting losses? Are you prone to overtrading? Do you find yourself constantly changing strategies? Once you've identified your psychological patterns, you can begin to create systems that specifically address those weaknesses. If you struggle with cutting losses, consider using automated stop orders. If you're prone to overtrading, implement a daily maximum on the number of trades you'll take. If you constantly switch strategies, commit to following one approach for a minimum of 30 trading days before evaluating its effectiveness. Remember, the goal isn't to eliminate emotions. That's impossible. The goal is to create an environment where you can trade effectively despite your emotions. With the right systems, community, and mindset, you can overcome the psychological traps that claim so many trading accounts. Trading isn't just about charts and indicators, it's about mastering yourself. When you develop the psychological foundation of a professional trader, you don't just transform your trading results. You transform how you approach challenges in every area of life. If you're ready to take your trading psychology to the next level, I invite you to join our Discord community of traders. We focus on systematic approaches to the market and support each other through the inevitable ups and downs of trading. It's a space where we can share insights, provide accountability, and grow together as traders. Just click the link in the description to join us.